Hello and welcome to IBKR Podcasts. My name is Chris McLaughlin. I am a computer science student at Purdue University, and I'm currently interning here at IBKR for the Enterprise Architecture Department. I'm super excited to be hosting today's special podcast episode featuring IBKR summer interns. Today, we're very excited to welcome Adrian Reid to the podcast. As background, Adrian is the founder of Enlightened Stock Trading. He is a trader, educator, and author who specializes in systematic trading and evidence-based investing. He has spent years developing and teaching systematic approaches to trading with a focus on building repeatable trading systems, portfolio construction, risk management, and removing emotional decision-making from the investment process. Through his educational programs, books, and coaching, Adrian has helped thousands of investors and traders improve their approach by relying on data, process, and disciplined execution rather than prediction or intuition. Today, we'll be discussing Adrian's journey into systematic trading, how traders can build and test robust systems, the psychology behind successful execution, and how emerging technologies like AI are shaping the future of trading. Adrian, welcome to the podcast. How are you?
I'm great. Thanks so much for having me. I'm looking forward to the panel interview. I've not done one of these for a long time, and this is gonna be fun. So let's
Of
go.
course, yeah, we're super excited to have you. So just to kick things off, I'm going to go ahead and hand it off to Jay to ask the first question.
Sounds good.
Hi, Adrian. As Chris said, we really appreciate and I've been really looking forward to having you on the podcast. Just a little bit about me. I'm a Rutgers student, rising senior, studying computer science. I'm a software dev intern at IB. And what I wanted to ask was, Adrian, you've been a mentor and educator to thousands upon thousands of traders. I wanted to ask on your sort of come up, did you have any sort of figure like that?
Yeah, it's a good question. I think mentoring is really important. It makes such a difference to how fast you can master something. And you can probably see here, there's a lot of trading books that I've kind of used and benefited from over the years. When I was starting out, mentoring was not really that available. So it was really a case of kind of from a distance observing people who I respected and could learn from and trying to, get as close as I could to them without necessarily being in their physical presence, particularly being in Australia. A lot of the major kind of trading figures at the time, and this is more than 25 years ago now, a lot of the major trading figures were in the US. And so I was a long way from them. But probably one that stands out that I really was influenced by a lot early in my journey is Dr. Van. Unfortunately, Van's no longer with us, but I benefit a lot from his books, and we had a couple of courses that I did online and live over the years that really shaped a lot about my trading journey, especially in the areas of risk management, actually long-term survival. So I kind of credit Van, I guess, with my survival in the markets, at least in the early stages. And that's, I think that's really important because one of the most important things in trading is you've got to survive. If you blow up your account, you're done and you have to start again. And that just wastes years and years of compounding time. So I think, in terms of mentoring in the trading space, at least that would be one. There's several other authors who are major influences in my life, my trading life. But Van would be the biggest one because I think he's who was responsible for my survival long term.
Thank you, Adrian. And I had a follow-up.
Sure.
How would you sort of illustrate the sort of impact? I know you didn't necessarily have a direct mentor, but how how would you accredit those sorts of figures, those sorts of resources to your success?
When I was starting, no, I didn't know any traders. So that's the first point. So I had to learn from someone. And I didn't even know any aspiring traders at the beginning. And so I just started reading. And I went through this divergence, convergence kind of process for my learning. And the divergence started with just getting whatever books were available locally on trading and investing and trying to kind of learn broadly to figure out what it was all about and what I really needed to learn. And eventually I discovered systematic trading, and I discovered systematic trading through the Market Wizards series from Jack Swager. And that was a pivotal point because as soon as I discovered systematic trading, I realized that was my thing. That was going to be my thing because I'm an analytical person. I studied engineering. I'm quite quantitative. I like numbers and analysis and math. and quantitative trading really just leapt off the page at me. And so after that, I basically spent time on Amazon finding every book I could on trading, technical trading, quantified trading, technical analysis, all of those things, and basically was ordering boxes and boxes of books to help me on my journey. Again, a lot of this stuff wasn't available in Australia at the time, so I was having crates of books delivered from Amazon, reading them, throwing a whole bunch of them away because they were garbage, and really just going through the ones that had value and dog-earing the pages, writing notes in the margins, and so on. So I think that divergent process to identify my niche in the trading world and then converging on that and finding the authors and the teachers in that space and going deep on learning with their content is what's really responsible for helping me get there, get through the initial stages to some level of consistency and some level of profitability. Does that kind of answer the question?
Oh, for sure. And I just think coming from a starting point where you didn't really have a lot of people, a lot of resources, and to accomplish what you've accomplished is so impressive. I had one more follow-up to that. So you mentioned, you're really interested in numbers, quantitative data. Did you always sort of have that interest, or was there like a moment or a stretch of time where you realized like this is something that I'm really passionate and interested about?
Look, the analytical side of life is probably always where I've been most comfortable. I mean, in school, once I hated, but pretty much I hated English and I hated any of the social subjects. I was no good at languages. I was no good at music and like any of the creative stuff. It just wasn't my jam. But in math class, in chemistry, in physics, I felt comfortable and at home. So I think it's an area of life that has just always been more natural. I won't say it comes completely naturally. I mean, obviously I had to learn and whatever, but they're the sorts of subjects and topics that I like. So going from school to university, the choice of something analytical was again obvious. Engineering was the choice at the time for people who were kind of good at math and liked physical things and was fascinated by how the world worked. And then engineering led to problem solving, and problem solving led to kind of the markets in some way. And trading is really a problem solving kind of journey, figuring out what works, what doesn't work, why, and putting rules around it and creating trading programs that work. So I don't know. In hindsight, it looks kind of natural, but yeah, I guess I like the analytical side of life.
Yeah, I can totally relate. I'm much more of a math guy too. So I'm gonna pass it back to Chris.
Thanks, Jay. I kind of actually have a question that builds off of that a little bit. You mentioned really appreciating the analytical side of things, and I am sure there's a lot of other people out there, maybe even some people listening that are kind of in that same boat, but systematic trading can seem like a really intimidating world to break into. From your experience, what would you say are some of like the non-negotiable skills and foundations needed before a new trader can create their first system?
Yeah, it's a good question. And it does look intimidating from the outside. And I think it looks intimidating because a lot of people overcomplicate it. And, when you think about quantitative trading, often you kind of get these images of hedge funds with PhDs in math and complicated coding and analysis that you look at on the page and you actually don't understand what it means. So I want to be upfront and say that's only one aspect of systematic or algorithmic trading. Like it doesn't have to be that complicated. I'm not a math genius. I'm not a programming genius, and you don't need to be. So what are the non-negotiable skills? I think the first one is fascination with the markets. And that's because it's not easy. It's not easy conceptually. Like there's some concepts you've got to grasp and some skills you've got to develop, and you have to learn to do some things which are not taught in schools. They're not natural. And it's also not easy emotionally because you're going to be challenged when your account is going up and down, when you have a sudden loss that you don't expect, when you're sitting there in fear, worrying about pressing the button to enter or exit a trade, if you're doing the right thing, your emotions are going wild. And to cope with those things, you need a reason. And just making money is not really a good enough reason. You've got to love the game. And I think most people who really win in whatever discipline in life love the game they're playing. And I think you've just got to love the markets. You've got to be interested in, like, why did that happen, and what is going on, and who's driving that, and how does that work? And if you have that fascination, then it helps give you the fuel to get through some of those challenges, both the emotional and the technical. So fascination with the markets is one. The second one, also a non-technical skill, is curiosity. And that's because most things about the markets are not intuitive. We come in, we study whatever we study, and we have these ideas about how the world works. And that comes from our training in school, it comes from our family interactions, it comes from our training at university or whatever. And then we come to the markets, and all of a sudden there's this emotional, irrational beast called the markets, and it does things that you don't expect. And it reacts to good news badly, and it reacts to bad news well, and it causes things that don't happen elsewhere in life. And so we've got to get curious about that and dig into why, and dig into what is actually happening. Because if we bring all of our preconceptions from life into the markets, we're going to be dead wrong. We're going to lose money hand over fist. So we got to be open to the fact that we might be wrong. We've got to be open to the fact the way we think money and the world and economics works might be wrong. And an announcement that looks at face value to be hugely positive might push the share price down because it's not as positive as what people were expecting, or because people were expecting something different, or because people didn't like what they heard. And so it's not always rational, and it's not always intuitively obvious. In fact, frequently it's not intuitively obvious. So if we can get curious and be open to learning about how the markets actually move rather than how we think they should be moving, then we can really start to make some inroads. So the two things are fascination with the markets and curiosity, completely not technical things. Then we get to the technical stuff. I mean, you only really need basic math, and you only really need basic programming, particularly now in the world of AI. I mean, I can dream up an idea by looking at some charts, throw it to my AI kind of environment, and have it fully define the idea, fully code the idea, run it through my 15-step process to test and evaluate and fine-tune and improve it. And then it spits out a written report to me in plain English. I don't even need the kind of real technical stuff anymore, as long as I understand what's going on under the hood. So those technical barriers, I think they're reducing a lot. And it comes down to some of the things that I talked about earlier. Plus, probably a little bit of creativity. You need the math, you need the programming, but increasingly they're not really barriers anymore. It's more about those other things that keep you in the game.
Yeah, I think that's really interesting. I think the emotional side of trading is something that not a lot of people consider when they're looking at it from the outside, but I know I'm personally starting my trading journey here pretty early, and it's something that I'm learning to deal with pretty quickly, is kind of coping with things not going as you expect them to, and maybe the markets just aren't as easy as like numbers on a page. So I think that information and that advice is very valuable. Moving forward, I'll go ahead and hand the next question on to two.
Thanks, Chris. Just want to say it's been really great to hear about your experiences and insights. Adrian, my name is Tu. I'm a rising senior at Harvard studying econ and linguistics, and I'm an intern on the marketing project management team this summer. I just kind of want to expand upon your point of curiosity and the emotional aspect of trading, and talk a little bit about your evidence-based investing approach, as well as kind of what that means in practice, specifically of like how a trader gather, tests, and actually trusts evidence before committing real money, especially in times of like high market or economic volatility.
Yeah. Okay. Good one. Good question. So evidence-based trading is basically what I like to do is never place a trade that I haven't tested and validated with some sort of data. And of course, you don't know in the moment how that trade's going to pan out, but the conditions in which you're placing a trade have probably happened many, many times over the last several decades. And so what I want to do is look for data that I can use to model a strategy. And in its simplest form, and frankly, in the markets, often just keeping it simple is the best thing to do. So in its simplest form, that looks like getting the historical open, high, low, close volume prices for any instrument that you're trading, and then applying your trading rules to those. So think pure technical analysis. A price breaks above a 200-day high, it's probably going up. This is all hypothesis, by the way. So imagine you look at the chart and say, okay, the chart's going up. If I bought here and if I sold when that happened, that should make money because look at this one great example on the chart. One great example means nothing because the markets are so noisy. But if you look at that and say, all right, well, I got a hypothesis that if I did that over and over again on many stocks over many years, I would make money. Then you take those rules, you apply them to that data, and you test it historically, and you see how it would have performed. And so, this is the process of backtesting. And that's, I think, one of the most important skills for a quantitative trader is to really be able to take your hypotheses and test them on data that exists in the markets. And that data might be price data, interest rate data, it could be economic data, it could even be social cues or social kind of chatter about how frequently a stock is mentioned or something like that. But the easiest data and the best data to start with is pure price data, because price allows you to develop strategies that work. Not all price-driven strategies work, but pure price strategies can work. And so that's simple data. It's easy to get. It's easy to model because there's not too many variables that are uncontrollable. If you're just creating a strategy on the price history of a stock, you get that price history every single day. It comes in at a certain time. It's available when you need to make the decision. So basically you take that data, you overlay your rules on it, you see how it performed, and then you validate or invalidate your hypothesis. There's of course a whole process around this. So when you're backtesting a system, we're creating the hypothesis rules, we're running some tests to validate that there is actually an edge there. Then we refine those rules. We probably optimize, vary the parameters to make sure that we've got some sort of stability in the rules. If the 200-day moving average adds value and the 150-day moving average adds value and the 300-day moving average adds value, then the moving average probably adds value. But if the 200-day moving average adds value and the 190-day moving average doesn't and the 210-day moving average doesn't, then it's probably just a fluke in the data. So a big part of our job is figuring out what is real and actually adds value and what is just a fluke in the data so that we don't fall victim to data mining and overfitting. So we need a process to go through that. But essentially, we're taking a hypothesis, backtesting it on real data that would have been available at the time we were making the trade, and seeing if we can design a system that worked in the past, then validating it on unseen data, and then going live and testing it with real money and then scaling it up. Does that explain sort of clearly enough what you're
Yeah, for
looking
sure.
for?
And I think it's interesting because, given how uncertainty it can see trading can seem as like a young investor, it's reassuring to hear that there are some concrete methods and good practices to follow in order to take some of that risk and uncertainty away.
Yeah, the uncertainty is actually really important here because one of the things that holds people back is the belief that there should be an answer and one right way to do it. So what's the best rule? What's the best moving average? How wide should my stop loss be? What should my risk return ratio be? People ask questions like there's one answer, but there's not one answer because the data is noisy. But that's okay. We just need to think beyond the trade that's in front of us. We need to think about hundreds or thousands of trades in the future and make sure that our method over many trades with a lot of noise and a lot of variability will give us an edge. And what's interesting is often the edge is not what people expect. When we come out of school, we expect that being right gives us the edge, right? I mean, no one wants to get 40% in an exam, okay? But you can make tons of money being right 40% of the time in the markets. And this is a massive mindset shift that most people can't cope with. Because if you're right 40% of the time, that means you're wrong in 60% of your trades. But if when you're right, you win really big, and when you're wrong, you lose really small, the math works out that you make a ton of money if you can place enough trades. So we don't actually need to be right. We just need to have an edge. And having an edge means we need to often accept being wrong, but make sure that we don't lose much when we're wrong and we win a lot when we're right. So that uncertainty is a real mindset shift, and the variability of the data is a real mindset shift. And we've got to elevate our thinking from the trade that's in front of us to the strategy that's driving the trades, and then elevate from the strategy that's driving the trades one level further to the portfolio of strategies. Because even a strategy applied over and over again has a degree of uncertainty. And if we apply many strategies that are diversified, non-correlated to each other, then we start to do a lot better and we start to get more consistent returns. We're sort of abstracting away from the uncertainty or the variability, and the portfolio gets smoother and smoother and smoother.
Yeah, that's great. I think your explanation on the nuance of, like having an edge and kind of taking a look at the bigger picture is really, really insightful. And then, so with that, I'll turn it over to Drew for the next question.
Thank you. Sort of building on that, I wanted to ask, how often should you be changing your parameters and or copying the automation rules of potentially more successful portfolios? And as part of that, how do you avoid going into like the kinds of subjectivity and second guessing that automated trading is supposed to avoid when you're setting up these different types of parameters?
Yeah, there's a few bits to that question. So the first part I heard was changing the parameters in your system. The second part was copying other people's rules and automation approaches, and then the subjectivity. So let me cover those in turn, because I think they're all really important. The first one is about your own systems. How often should you change your own system to adapt to the market, to tune it up, to make sure that it's relevant? And the answer is generally much less often than you would think. Because what you want to think about is why you're driven to make a change to the strategy. And usually if you've got a strategy and you've proven in the past that it worked and you're applying it, you're generally driven to change that strategy because you just had a losing trade or you're in a drawdown. It's like, oh, I'm trying to avoid losing trades and I'm trying to avoid drawdowns. So let me just optimize this or fine tune it, change it a little bit or a lot so that it works now. But it's a trap, because re-optimizing and fine tuning or changing the parameters to make the system work now is based on the trade you just took. That's still the past. And the next trade is still unknown. So the parameters you're about to change it to may be no better than the ones that you had. It's back to the previous point about the uncertainty and the variability of the markets. We have to accept that there's losses and there's more of them than we would like. And they're often more frequent and bigger than we would like. We've got to try and keep the losses small to survive. But the key is to develop sufficient confidence in the strategy so that you can trade through a drawdown without being tempted to tinker with it. Because if you change the strategy and then you have a loss, you change the strategy again, you have a loss, you change the strategy again, you end up in this spiral where you just keep going into bigger and bigger and bigger drawdowns and you don't recover because you're changing the strategy the whole time. But if you keep the strategy constant, then you have a drawdown. Usually, if it's a good strategy, you come out of the drawdown. But if you change the strategy, now you've got a new strategy. And there's nothing to stop you having another drawdown. And then change it again, another drawdown. So it's actually a bit of a death spiral. If you keep changing the strategy, you keep going into drawdown and your account basically just gets whittled away. The key is it a good strategy? And that's something that, that's a harder question to answer. You need that testing process that takes you through multiple stages to evaluate the edge and to check that it's stable, check that it's robust, check that all the rules are significant, check that it works on seen and unseen data on related markets. There's a whole bunch of tests you can do to build that confidence so that when you go into a drawdown, you're not tempted to change the strategy. So not very often is the answer to the first question, but you need to monitor it often, because we want to monitor our strategies and make sure that they're still behaving the way they're supposed to. And drawdown is something that every strategy has. There's supposed to be drawdown. You cannot avoid it. And if you try and avoid it, you can't succeed in trading. There's always drawdowns. There's always losing trades. So we need to monitor our strategies to make sure they're not broken. And things can change. So strategies can break. What can change that causes a strategy to break is all sorts of things. It could be market behavior. It could be market rules. I mean, in the past, there's a whole bunch of things that have caused different strategies to break. Changes in commission levels, changes in the market. So when the markets moved to decimalization from fractions in the share price, that changed things. When high frequency trading started, that changed things. It changed the way the markets moved, which killed some strategies. So you need to monitor the strategy on a regular basis, weekly to monthly, depending on the duration or the time frame of the strategy, and check that what it's doing is is within the bounds of normal based on its historical behavior. So we don't change our strategy very often, but we monitor it often. And if it looks like the strategy is diverging from how it has behaved in the past and how it should behave based on our testing, then our job is to intervene and ask why. So back to the idea of curiosity. What happened here? Why has this changed? Is it behavioral? Is it, did I make a mistake? Is it more fragile than I thought? Dig into why. The next part of your question, so does that cover the first part? How, yeah, good. So the next part of the question was, how often should we be copying other people? And I think, look, we all learn from other people. Look at the books over my shoulder. I've got tons of ideas from other people. I read websites, articles, journals about trading. I listen to podcasts. I get ideas. So I think that's really important. But what we don't want to do is jump from strategy to strategy to strategy. What I'm trying to do is build a portfolio of strategies that complement each other nicely. So if I read something and find a strategy or an idea from someone else that is a good complement to my portfolio, then I'll test it and add it in if it adds value to the portfolio. And that's a testing process, because not every strategy adds to what you've already got. But if it's low correlation, if it adds diversity, if it improves your risk-adjusted performance, if it improves your performance in an extreme market dislocation, then adding someone else's strategy is really powerful. Make sense? So I think we all got to be humble enough to learn from other people, but we've also got to be skeptical enough to test what other people say and build confidence in it ourselves. So just because, some guru or some big name talked about this approach doesn't mean it's going to work for us. We have to still test it and validate it and still build the confidence in it, because it's our money on the line. And when it's our money on the line, it's our emotions that are going to muck it up. So we have to have absolute confidence in the strategy. So we've really got to go through that testing process to get all our questions and concerns out so that we can then follow it as if it was ours. Now, I think there was a third part to the question, but I forgot what it was.
Yeah, it was just, when you're making those calls, how do you avoid being subjective?
Oh yeah, being
much as
subjective, the emotional side of it. Because quantitative trading, systematic trading, algo trading, whatever you want to call it, they're all basically the same, similar sort of things. It's designed to take the emotion out. And so in the day-to-day, when you're following the buy and sell rules, yeah, it does. But the trader still has the ability to press the override button, or to press the eject button, or the stop button, or to jump in and re-optimize the rules like we were talking about earlier. So that comes down to confidence. And I think there's a couple of tools that you can use, not technical tools, but processes The first one is journaling everything that you see and do in the markets and learning from how you're feeling. So this happened, it made me feel this way. And then taking that and turning it into testing. So one of the great techniques that I think is massively underused, mostly because no one talks about it. I talk about it a fair bit, but is backtesting your emotions. And so when you've got a strategy and something happens and it causes an emotional response, which makes you want to react, I step back from that and say, all right, what happened? And what was my emotional response? And I try and turn that emotional trigger into a rule that I can test. Oh, that stock was way more volatile than I thought. Let me put in a rule to filter out volatile stocks so that I can avoid trades like that in the future and see if it improves my strategy. And when you test these triggers of your emotional reactions, you generally see that your emotional reactions aren't helpful. So, oh, this stock is really gappy from one day to the next. Let me put in a rule that eliminates stocks that gap overnight and see if it improves the strategy. So I'm not doing it to tinker with the strategy. I'm doing it to prove or disprove that my reaction to the markets was real or meaningful. And most of the time, your emotional reactions, you disprove them by doing that because they're just emotions. They don't actually help in the markets. And when you disprove the emotional reaction by analysis, you go, oh, okay, I can just ignore that in the future. And it calms the whole thing down. So the more you test your ideas and your hypotheses and your emotional reactions to the market, the more you can just have confidence to let your strategies run. So I'm doing a lot of testing, but I'm not doing a lot of changing of what's live in the market because the testing is all about making sure that I'm maintaining confidence. And so I test fast, but I change very slow.
That was great. Thank you so much. You've really opened up my eyes to like what the world of trading can be.
Okay, cool.
And I'm a lot more interested. So with that, I'll pass it on to Will for more.
Thanks, Drew. And thank you, Adrian. It's been really interesting to kind of hear how you apply your thinking to different levels of uncertainty. And I actually had a question regarding the actual testing process, if that's all right.
Sure.
You mentioned having a lot of confidence in your systems and kind of the mistake of looking at limited sets of data that might appear to work for a strategy that end up being kind of uncorrelated. So what are some examples of potentially dangerous mistakes that you see people make when they're backtesting systems that kind of give them that false sense of confidence?
There's so many mistakes. I can't tell you, honestly. Some of the biggest mistakes are really driven by trying to get certainty and trying to build an outstanding strategy. Trying to build the one strategy that will make you all of the money that you want and generate all of the profits to achieve your goals. Because when you're trying to develop a great strategy, you miss so many good strategies. And the trouble with trying to develop a great strategy is that all you can develop on is past data. And so what looks great in the past, at best, is probably only going to look good in the future. So trying to develop the best, an outstanding strategy that has a super smooth equity curve, ultra high Sharpe ratio, very low loss, rate of losses, high win rate, big wins, small losses. You can only really do that by overfitting the data. And overfitting the data means your rules are fine-tuned to exactly what happened in the past. And so when you apply them to the future, they don't work because they were really precisely tuned to the exact circumstances in the past. And the future is not going to be exactly the same as the past. They say the future's past performance doesn't predict the future, but it kind of rhymes. And I think that's a good way to think about it. It's going to look and feel somewhat similar, but the exact movements from day to day, from week to week, are not going to be the same as they were in the past. So the biggest mistake is really trying to develop an amazing strategy and adding too much complexity, too many rules, doing too much optimization, because you end up overfitting and you end up with a strategy that looks great in the past, but doesn't perform in the future. The goal of a systematic trader should be to develop a strategy that survives through multiple market regimes and survives on unseen data, because the future is unseen. So we need some simple, blunt, robust rules that keep us safe and allow us to capture some profit and allow us to get out before we give all that profit up. And so good strategies are typically far simpler than most people think when they're starting out. And so if you find yourself adding rules and filters and exotic kind of conditions and pulling in lots of different data sources to get consensus, you're probably overfitting, and you're probably not going to end up with a strategy that works in real-time trading. So keep it simple is the best advice I can give. The fewer rules, the better. And the more trades in your sample set that allow you to profit from those simple rules, the better.
Got you. Thank you so much. I had another question about overfitting.
Yeah.
I know a lot of like AI and machine learning are increasingly used to kind of scan through data for different patterns and edges that humans might not be able to see themselves. And so do you kind of see that AI as like a genuine edge, or does that risk of overfitting cause a lot of potential issues?
Both. Absolutely both, depending on how you use it. It's kind of like, if you've got a hammer, then that's a really great tool for some things, and it's not a really great tool for other things. A hammer's pretty good at hammering nails and removing nails, and it's not very good at performing surgery or, tightening a bolt or something like that. AI is really great at some things and really not very useful at other things. So what I use AI for is research to find ideas. So, scour the web, scour social media, pull in what, certain people are saying in terms of like people I respect or other people that develop systems to give me ideas to develop strategies to trade with. So it's really great at kind of scanning what's available, looking at papers and pulling out ideas and rules from finance journals and those sorts of things. It's great at that. If you ask any AI tool for a profitable trading system, you're going to get garbage. Because AI tools are trained on data sets that are public. And if an AI tool is scraping social media and all sorts of random websites and pulling together the consensus kind of answer on what is a profitable trading system, what's the probability that that's actually right? I mean, if you read every website and every social media post about trading and took kind of the average most common answer, do you think it would be profitable? Of course not, because most people aren't profitable in the markets. Most people lose money. So asking an LLM to give you a trading system doesn't help. However, you can give it your process and have it run your process for you to speed you up. So as we speak, Claude Code is doing analysis for me the way I would do the analysis. So it's coding up the system rules and it's running the tests for me the way I would run them, including all the steps in my process because I've programmed that. I've created the skills to do each step of my system development process. And then it spits out a report at the end to tell me whether the idea was any good. And not only that, it looks at the analysis that it did and the conclusions that it found, and it brainstorms new ideas and puts them in at the front. So that process, I would do that myself. And I have done that for over 20 years. Now it just happens faster. So it speeds it up. So it speeds up the discovery. That can speed up the discovery of luck, flukes in the data and so on. So you don't want to trust that blindly. I have an incubation process, which any strategy will go through. And I'll, of course, when I get a strategy out the end, after Claude Code has followed my whole process, I'll really critically evaluate how that was developed. Just the same as if a student gave me a strategy, I would very critically evaluate how that was developed and make sure that the testing was sound, the conclusions were sound, that the right ideas were added in, and I might go back and retest certain things. But it's a really great tool to accelerate us as quantitative traders. We don't need to write our own code anymore. I don't write code anymore. I just kind of give it the rules in plain English, and it says, hey, you missed this and you missed that, and then it codes it up, and then it can run the testing process for me. So I think it's a really powerful tool. In of itself, it's not an edge. I would say it's an accelerator. It's an accelerator for idea generation, and it's an accelerator for coding and testing. But I very much doubt that if you plug an AI into an account and said, make me money, that it would work yet. But, I could be proven wrong. I just know that if you have back-tested strategies that have survived multiple market regimes over multiple decades, and the strategies are very robust and stable, then it's possible to make great returns in the market, and the AI can help me discover more edges like that. So that's how I'm using it.
Gotcha. Thank you so much. That makes total sense.
Yeah.
I'll pass it off now to Devika. I think she had a couple questions as
Hi,
well.
Adrian. My name is Devika. I'm a finance and fintech student at Georgia Tech. And I was just wondering, I know you've traded through some pretty brutal market environments like 2008, 2020 COVID crash, and rising rate environments. So could you just describe emotionally what it feels like to sit in a drawdown when your system is telling you to stay the course?
Yeah, it's interesting. And I think sitting through drawdown is probably the hardest thing traders have to do, because no one likes to see their money erode. I mean, when we go to work, we like to get paid. And when you go to work in the markets, often you don't get paid. Often you have to pay for the privilege in the form of drawdown and losses. So look, emotionally, it's tough, but what we need to do is develop the resilience to sit through it, develop the confidence to sit through it. And so you do that a couple of ways. I mean, we've talked about testing a lot, so I won't go back into that. You really need to understand how your strategy has performed through environments like that, so that when you come across environments like that, you know what to expect. And so a good technique is to look at the equity curve, the back-tested results of your strategy in detail, not just, over 30 years, it made, huge amounts of money. That's fantastic. And it had a 10% drawdown. Great. I can cope with 10% drawdown. Looking at the superficial surface stats is not enough. You need to go down to the day by day level and the trade by trade level and see what actually happened under the hood. Because when you're at the hard right edge of the chart and you're placing the trade and you're watching your account, that's when the emotion comes up. So you test at the macro level, not macro as in macroeconomic, but macro as in zoom out 20 or 30 years of data, right? You test at that level and go, wow, this is great. I'm going to be rich. Woo! But then you zoom in and you trade at the micro level, which is, holy shit, I had another loss, another loss, another loss. Oh, I'm in drawdown. Oh, I've been in drawdown for 3 months. Oh, is that normal? And so that's all the emotional stuff. So you've got to test at that macro level, but then zoom in and look at what to expect at the micro level, the day by day, trade by trade, and see what's normal. Because when you've seen in the data what's normal, when it happens, it doesn't freak you out. And then you've got the confidence to see it through. So I think that's probably the biggest tip. Go from that big long-term time frame testing, develop the system so it works, but then really zoom in and inspect and interrogate what could happen. What's the best trade? What's the worst trade? How fast can these things move against me? How fast can they move in my favor? How many days in a row? How many losses in a row? How long is the drawdown? How did that drawdown look day by day? Do that so that you know what to expect. Then you can sit through it.
Got it. Thank you so much. That was very insightful. And
Great question too. Very
Thank you.
important stuff.
I'll pass it over to Kennard for the next question.
Hi, Adrian. My name is Kunal. I'm a master's student studying in quant finance and interning at IBKR in electronic trading compliance team. I completely agree with you. Everyone should have a system, rules, understand risk management in trading, especially with AI help. It has become very easy. So my question is about how AI has changed the systematic trading. We all can see AI and LLMs are rapidly entering retail strategy development. As per you, over the next few years, do these tools make your student better system developer or just fast curve fitters? Like, what guardrail should one follow while using AI?
Yeah, I think it's a good question. I think similar to what I said before, it has the potential to do both. It has the potential to make you a better systematic trader, but also to be a faster curve fitter. And we really need to avoid that. And I think the biggest mistake that people will make is completely deferring to the AI. Test this strategy for me. Okay. If you tell AI to do something, it's going to have a good crack at doing it, right? It's not going to say, no, tell me exactly how. It's going to look at its information and come up with an approach and have a crack at it. And that may or may not be sensible. So I think using it superficially is dangerous and will remain dangerous. But if you give it the process and you tell it exactly how to do the analysis, then it has the potential to speed up the good analysis that you would do yourself. If you give it a bad process, then it has the potential to speed up the curve fitting, the overfitting, and give you bad outcomes. So the fact that AI exists doesn't mean we don't need to understand the fundamental principles of solid systematic trading and correct backtesting and all of that. We need to learn that so that we can properly drive the tool. You know, if we're going to be a carpenter, we need to learn how to use a hammer. We need to learn how a house goes together. We can't just blindly trust a robot to build a house. We need to kind of be able to supervise, I guess, is a similar analogy. We can't just blindly let AI develop our strategies. We need to supervise it. And it's our money, so we need to be responsible. And I think, responsibility is, all the way back to the beginning, we talked about mentoring, and Van Tharp, who was really big for me in my early days, was personal responsibility is critical. How did I make this happen? What did I do to cause this to happen? And being fully responsible for everything that happens in the markets, in our account. And if we abdicate responsibility to AI, then we're not maintaining that control and accountability ourselves. And it leads too easily to blame, and it leads too easily to being removed from the process and bad results. So I think, to sum it up, actually learn and understand how to be a quantitative trader, and then use the AI as a tool with the processes that you've learned to accelerate you rather than deferring. Lots of people are going to come to the markets without any education and assume AI knows and defer to AI. And I think that's a mistake. Learn to be a trader first, use the tool, and then it's going to be very powerful. I mean, my testing now, the speed at which I can evaluate a hypothesis is so much faster than it was just 2 years ago. But I'm still using the same process. It's just all happening under the hood now. My backtester doesn't even pop up on my screen anymore. It all happens in a silent window that's hidden. But the same tests are going on that I would have done. So I think we need to use the tool correctly. Does that help? I mean, there's so much more to this. We could talk about this for hours, but I think that's a good start. What do you think?
Yeah, that answers well. Like, I also have same thought process on these things, to have the guardrails and everything intact, and human can't be replaced by AI on these things. Thank you
Yeah,
so much,
we are
Adrian.
augmented, right? I think we're augmented by these things, and the guardrails are the process that we follow, the testing process, the bounds, the rules about what is safe in the markets and what's not, and the rules about how to make optimization decisions. You've got to kind of educate the tool about how you would make the decision so it can make the same decision you would, so you can accelerate.
Thank you so much, Adrian. I will pass it over to Drew to close us out.
Yeah. Adrian, thank you so much for joining us and sharing your insights and experience. We've really enjoyed hearing about your journey, your approach to systematic trading, and your perspective on the entire process. We appreciate you taking the time to share your knowledge with us and our audience.
Thanks so much. It's been super fun. There's been some really great questions here. I hope it's been valuable for you guys, but also for the listeners. I think, look, in summary of all of this, systematic trading is such a blast. It's so interesting and fascinating to drill into what drives the markets and how to extract an edge, and also to learn about the psychology of how to actually, as a human, step back and let the strategies do their work despite the uncertainty, despite the fear. So if anyone's interested in pursuing this path, I would say it's been so instrumental in my life, and it's unlocked so many great kind of opportunities. And I've learned so much about the markets and myself by doing this. So keep asking these sorts of questions, And look, if anyone wants to pursue systematic trading, I'm more than happy to answer questions and so on in the future. So feel free to reach out.
Awesome. Thank you so much. And to our audience, if you enjoyed today's episode, please subscribe wherever you download your podcast from, and we'll be back soon.
Thanks, everyone.
The analysis in this material is provided for information only and is not and should not be construed as an offer to sell or the solicitation of an offer to buy any security. To the extent that this material discusses general market activity, industry, or sector trends, or other broad-based economic or political conditions, it should not be construed as research or investment advice. To the extent that it includes references to specific securities, commodities, currencies, or other instruments, those references do not constitute a recommendation by IBKR to buy, sell, or hold such investments. This material does not and is not intended to take into account the particular financial conditions, investment objectives, or requirements of individual customers. Before acting on this material, you should consider whether it is suitable for your particular circumstances and, as necessary, seek professional advice.